good morning. You're watching The Market right here in 18 Hour with me, Aisha Faridi, Anisha Jain, Avan Nabash in the studios. And for our markets, well, we're starting off on a brand new series. Who would have thought March is already here? Series-wise. But anyway, for the series gone by, the Nifty has had it rough for sure, right? We've dropped about 370 points in the series gone by, and that's a downtick of another 2% coming in. And off late, we've been testing even that 18K mark, or rather 17,800 print. We did test 18K as well on the upside. Yesterday too, we did see a sharp crack coming in, then recovered from there. We've slipped below the 200 DMA. Adani Enterprises, Adani Ports, these have all been very, very big drags in the series gone by. In fact, all broader markets as well have managed to close in the red. And FMCG is the one which has really shown bright with names like ITC resilient even yesterday and day before when the markets did go through a lot of chop and churn. But of course, the question is what happens from here, because other spaces which have been performing well 2022, like metals, for instance, they've as well fallen very sharply.
Well, yes, metals and the entire commodities. In fact, we were looking at this data as to what has happened in the 1 year since the war broke out. We saw that sudden spike in the commodities. But if you look at a 1 year basis, all the commodities are actually down. And that's telling you that perhaps the worst of inflation is behind. And maybe the margin pressures that the companies were facing, maybe the worst at least is behind. Let's pull up that 1 year data, what has happened with respect to the commodities over 1 year. So it's only iron ore and nickel on the screen which are actually showing a bit of a green tinge. But apart from that, whether it is a crude, aluminium, copper, industrials, metals, etc., they're all down. Even steel and silver and even gold for that matter, they're all down on a year-on-year basis. Even the agri commodities, so the likes of coffee, cotton, sugar, which had seen a sudden spike last year, they've all cooled off, except sugar, which is of course on account of a lot of other natural factors in Brazil, etc., where there has been a drought, etc. as well. Inflation, however, has also remained a bit volatile, and we'll bring that 1 year chart for you, wherein it started off with a level of around 6.1%, and we're now again closer to 6.5 as far as India is concerned. We of course hit at that high of 7.4% on an interim basis, so we went from 6.1% to 7.4, but we are back to at 6.5% when it comes to India as well. And for US as well, it's still going to be a long road for them going forward, but at least inflation is coming back to normal levels. And that's what the market is factoring in at the moment, that maybe at least the pace of increase of rate hikes is going to slow down, and we are at the faggest end of the rate up cycle, Avan.
Yes, absolutely. That seems to be what the data is indicating there, with all those commodities over the last 1 year since the war having seen a downtick. But moving away from that, let's focus in on how the global markets are trending as well. And overnight, you did have, for the most part, the US markets ending up in the green. That's the S&P 500 up 0.5%, and the Dow Jones as well mildly in the green, with the Nasdaq gaining. Still continues to remain in the spotlight, the path of the Federal Reserve's rate hikes, and you've got the Asian markets as well, piggybacking pretty much on that positive global sentiment. But yes, in yesterday's trading session, it was a choppy close. You had the F&O expiry, as we highlighted. There were low long positions for the next month, and it was the broader markets that really took a brunt, seeing an underperformance as compared to the frontliners for the series gone by as well. And as Aisha highlighted as well, in terms of the returns that we saw, the likes of metals, all of those really bore the brunt. And on the flip side, you had IT that did manage to gain along with FMCG. So inflation across countries as well, that is what we're monitoring, given the fact that it has been close to a year since the unfortunate war.
Oh, yeah, absolutely. Just looking at how the pre-market rates are and how Asia is actually panning out. Well, from the US, it was a decent handover, just mildly up in the green. At least that major part of correction that we came in with on Wednesday, that seems to be a little bit behind us at least, especially after the FOMC minutes. But yeah, the Nasdaq closing in with almost a 1% gain. The S&P Dow as well did pretty okay. In the pre-market rates as well, they're at best just about quiet. And Asia seems to be doing okay as well. Of course, Japan is seeing a very big move, about a 1.25% uptick. Australia, Korea, Hong Kong is seeing a very sharp downtick. It's down 268 points. That's a 1.5% downtick. Korea is holding up mildly. So it's a bit of a mixed bag, and that's exactly what the SGX Nifty as well seems to be indicating this morning.
Oh, well, yes, and also you have to watch out for the data PCE coming in from the US today, which is the most important marker for Fed to decide how the rate trajectory is going to be. It is expected that it's going to be around that 4.9% mark, but the personal consumption expenditure, that's the important data point, because overnight we got the initial jobless claims data. It's been below the 200,000 mark for sixth month on a row, 6 week on a row rather, telling you that the jobs data continues to be quite strong, and GDP also at 2.7% was not too bad. So overall, the US economy is on a strong footing. Let's see where the Fed goes from here on. But talking about our own market, and FMCG, as Aisha pointed out, was one of the top gainers in the series gone by. But what are the top bets from the sector? We posed that question to Saurabh Mukherjee.
Main FMCG plays Nestle, and one of the reasons we've been steadfast holders of Nestle over the last 5 years or so is the reinvestment ratio is very high for an MNC FMCG company. So they reinvest around half of their surplus capital, the other half gets dividended out, and that allows them to grow the business 10-11% volume growth steadily quarter after quarter, when the other FMCGs deliver say 3-4% volume growth. So if we can find consumer companies that are consistently reinvesting surplus capital to grow their growth, we'll be very happy to look at them. Amongst the non-FMCG players than consumer, Asian Paints, as we have said thousands of times, is a celebrated play on that, right? Their $1 billion capex announcement, growing not just the paints business, but even the home decor business, is symptomatic of what makes for a champion franchise in India. Similarly, Pidilite, I think 3,000, 4,000 crore capex underway. That's what you need to see, not just a stable franchise, but high ROCEs being reinvested to grow the economy, grow the country, grow the market. Investigated by management. So this is a company with very high cash conversion. So operating cash flows typically higher than operating profits. There's no debt on the balance sheet. This is a high margin company. If members of management, distinct from the promoter, members of management are doing anything naughty, I'm sure the Deloitte investigation will pick it up, and we as shareholders will be very happy, because then the operating margins will go up further. This is already a very profitable company with 200, 300 crores of cash on the balance sheet. If somebody has been naughty in the management team and has done naughty stuff in terms of pilfering from the company, then we would, as shareholders, be delighted if those people are caught and the margins rise even further. So I'm not particularly perturbed about the whistleblower thing. I'm very happy that the management, the board has hired Deloitte to investigate the matter.
All right, that's Saurabh Mukherjee walking us through some of the sectors that he's bullish on. Let's move right on then. Lots of stocks that are in the spotlight in today's trading session. And in particular, you did see Zee Entertainment bearing a brunt in yesterday's trading session, although the stock did manage to recover. Now, do remember, you had a response coming in just about at the time of close of market, where you have Puneet Goenka of the company going ahead and saying that they have filed an appeal. This is in the National Company Law Appellate Tribunal, or the NCLAT, and the appeal is in order to seek a relief against the order that had been passed by the Mumbai bench of the NCLT. Remember, the NCLT had admitted an insolvency plea. This is of IndusInd Bank against the company. They had claimed a default of about 83 crore rupees, and the company had given a guarantee for IndusInd's bank 150 crore rupee loan to City Network, also admitting an insolvency plea against City Networks. So the company categorically saying that they are taking all necessary steps as per the law in order to protect the interest of the shareholders of Zee Entertainment, and in order to achieve a timely completion of the proposed merger with Culver Max. Do remember, the concerns loom large with respect to now what the course of action is going to be with respect to the merger with Culver Max, although UBS had maintained a buy rating with a target price at 350, saying that this is overall a negative development. But we also interacted with Karan Taurani of Elara Securities, and he believes that the drop in the Zee price, stock price, is a buying opportunity, and he says nothing worse can happen from here on. Listen in.
I think one can definitely use this dip as a buying opportunity, and one can start accumulating, because if you look at the valuations, clearly, even if you include the OTT losses and you assume that the merger is not going to happen, it is trading at almost 16 times 1-year forward P. And if you look at other scenarios that we have built in, that the merger happens and then there's cash infusion, and even if you exclude or include OTT losses of Sony Live and ZEE5, both as OTT platforms put together, the valuations are in the range of 6.5 to 10 times. So valuations are compelling, provided that the merger basically goes through. But assuming that the merger does not go through, even then, I think the valuations are at reasonable levels and don't offer too much of a downside. So we believe that nothing worse can actually happen, from here on. And had the outstanding liabilities been larger in terms of the overall value, we would have taken a cautious stance over there. But because the amounts are so small, because there is a cash available, there is also a potential cash infusion which is going to come in, after the merger. We believe these are very small events, and I think the price is kind of overreacted basis that.
Okay, let's move on and let's talk about the trade setup this morning, considering we're kickstarting a new series but also leaving behind quite a damaging one with the Nifty breaching its 200 DMA, testing 18K, but then even breaching below the 17,800 mark. And many days we just about consolidated and were extremely, extremely sideways. Finally closing in at 17,500, which also we saw a breach of in just, the last couple of trading sessions. Kunal Naresh on the show with us as always. Kunal, hi morning. Let me come to you first. Done with the series, a bad one, a 370-point fall on the index alone. A lot of other factors at play as well. What's it looking like for March?
Yeah, but the last couple of days, the only good part is that we've protected the 17,500 mark broadly. So yes, there have been intraday tests for the index below the 7,500 mark. But the weaker link for the market is the weakness in Bank Nifty, and new trends, they generally don't emerge when you have the banking stocks on the banking sector. They are under pressure. So I think the only hope of revival for the markets would be if the Bank Nifty starts to get into any kind of a recovery mode. Now, the rollovers data yesterday still indicates that the Nifty rollovers was almost on an average over the last 2 to 3 series, but the Bank Nifty rollovers were a tad bit more higher. And if you go by the trend, the recent trends for the indices, then it indicates that this is more to do with short rollovers which have happened on the Bank Nifty as compared to Nifty. So all in all, I would believe that the banking stocks would continue to be weaker over the near term, but the Nifty can hold on to that 17,500 mark.
Naresh, hi morning. In the series gone by, and I don't want to talk about the index, but I want to talk about the pain points and the big movers. And I'll come to FMCG in just a bit. But the Adani group of names, considering all that was transpiring, was in the series gone by, the Feb series. Do you see any recovery in place for an Adani Enterprises or ports? Because they're still continuing, they're continuing to lose on a daily basis.
So, if we look at Adani Ports, that is the only stock which made a decent recovery and is still holding on to it. So, Adani Ports closer to 520 is an entry price. It is still away from that, but at current levels, the risk reward is not great. Adani Enterprises will continue to remain very volatile to actually trade. So, would not be stepping in out there. But I think the bottom at 1,000 is done. And now we try to find a range on this stock, and that could possibly be between 1,000 to 1,700. Now, that itself is a very huge range for any stock to trade. Now, that's a range which lasts for years for a lot of stocks. And out here, we've made moves from 1,000 to 2,200 in a week's time. So, in such a scenario, you don't want to participate. Same is the case with all the other Adani Group companies. The only one which I continue to like is Ambuja Cements at 330 levels, which is where a recovery eventually could be closer to 400, 420.
All right, let's find out some individual stock strategies as well as we've stepped into the new series. And Kunal, What is it that's catching your eye this morning?
So I'll go with two buy calls. The first one is on Indian hotels. We discussed this 2 days back as well when the stock was sub 300 levels. So would retrade a buy on Indian hotels, again expecting the stock to get into a recovery phase. The mean reversion has happened for the stock. So would suggest a buy. 320 remains to be a target, and upping my stop loss from 290 to now 302. The second would be a buy on Bajaj Finance, classic bullish hammer pattern which was seen on the charts yesterday. Again, a stock which has retraced quite mildly as compared to the other NBFC stocks. So would suggest a buy, 6,400 as a target, stop loss at 6,160.
All right, let's find out what it is that Naresh is picking out for the day. Naresh, your strategies?
So expecting a bounce to come in banks, and that is where I take the two large cap banks. So the first is a buy on HDFC Bank. Now the stock has a number of support points at 1550 to 1590. The recent big gap up, the lows of the last few weeks. And from that zone, we could again go back to 1700, 1750 levels. And a longer term breakout happens above 1750. And the stock today at 1600 levels is where it was in February 2021. So a 2-year return for HDFC Bank is 0. So there can be a catch up, and going forward, this could be the bank which could lead the bank Nifty. So expecting HDFC Bank to eventually break out also. Currently at 1600, the risk reward is good for an entry point with a medium term view as well as short term. Second is a buy on State Bank of India, which has corrected quite a bit in the last few weeks. 480 to 500 is a strong support band. Yesterday came to 520, which is where I would take a risk reward bet with a stop loss at 510 and a short term bounce target of 550.
Okay, finally, the buy calls coming in for financial names in both the heavyweights, SBI and HDFC Bank. It's long overdue after the stark underperformance of the Bank Nifty of late. Let's see if those recover today or over the period of next week or not. But time now to slip into a very short break. But as we do that, we leave you with the opinion coming in from Mr. Vikas Prasad. He's the portfolio manager, Asia Equities and M&G Investments. He's quite cautious about the positioning of the private banks at the moment as well as autos.
It's less an absolute concern about the banks, more just a relative positioning and where the relative returns are. So I think if you look at the size of the loan books and the growth that is priced in for them, in percentage terms, these numbers are high, but in absolute terms, it's so large. So where we see better opportunities, not that we don't have good opportunities, we have good opportunities. Where we see more and better opportunities are in some of the smaller companies, housing finance. If we look at housing finance for the lower and middle income groups, I know there are some sectors in consumer discretionary, consumer staples, where if you're exposed to the mass market, there's some concerns, and we can talk about that. But in housing finance, I think that's a very long-term story for growth, and we have our capital there. When we look at two-wheelers, we expect that divergence to continue. So when we last spoke in November 21, 15 months ago, our effective exposure to the two-wheelers was close to zero. It's not zero any longer. There are some underweights or shorts that we have closed, and the work continues. The work that we are doing on the private side is informing the work on the public side, and vice versa. It's making us smarter on both sides. So the two-wheeler story, I think there's partly because of the pent-up demand, and also because of the shift from these ICE vehicles to EVs.
Yeah.
Yes, and the opportunities that we see, actually the private companies have surprised me to the positive. And the listed companies, I think I would have expected more from them by now. But they can be fast followers. We've seen this in other industries where the incumbents allow people to burn a lot of money, develop products, and then with their scale and their size and their acumen, then they come and they eventually take the lead. That could still happen. This race is not won. We're still closer to the beginning.
But are the ones who are going to catch up on the EV race going to be the fastest ones to win?
You mean on the private side?
No, across the board, four-wheelers, passenger vehicles in particular.
It's very interesting. I think if you look globally, the adoption of EVs has exceeded general expectations, certainly mine. I think that I read a stat recently that EV sales have crossed $1 trillion for the first time globally. And if you look at the penetration rates, two-wheelers, four-wheelers, CVs, scooters, personal mobility, all of that is accelerating. Related to that is the component technology, the component industries, the battery industries, energy storage, energy charging. And a lot of those roads lead back to India, China, and Korea, which is why I think those areas are worth looking at as well. And these stories will take a long time to play out. So we'll be able to invest in the space for a long time.
Welcome back. Today, the SGX Nifty is indicating a fairly muted start, up about 50 plus points in trade. And for the most part, Asia has reversed those gains now. And Shanghai, the Hang Seng, as well as the Kospi Index, those are looking tempered this morning. Well, let's get a move on then and take a look at what Chris Wood's Greed and Fear latest note is. Financial markets seem to be pricing in the risk of a more hawkish Fed stance, seems to be the take, while the money markets are discounting rate hikes to about 5%. Let's take it across to my colleague Sharad, who joins in with all the other key takeaways from that note. Morning, Sharad.
Well, yes, an important development coming in from Chris Wood's Greed and Fear Index, and of course the report has stated that the markets are actually continuing to price in the risk of a very hawkish stance coming in for Fed. Now the money markets, what are they expecting? They're expecting almost a 78 basis points of another discounting in the rate hikes, expected to come in at almost 5.36% for the US rates as well. But there seems to be a confusion, especially in the reaction on the stock markets and what the consensus is expecting when it comes to Fed rate hikes. Now, of course, there is a national questioning also involved as per the report itself. But do remember that the monetary tightening expectations had already peaked in the US markets last year in the month of November itself. Now, apart from this, the report also stated that the America's small business would be in focus, especially because they are hurt the most when it comes to margin compression. Now, looking at the numbers over here, the report has stated that the small business sector actually accounts for almost 44% of the US private sector's employment as well. But going ahead, what does the report say? The important thing is that the Greed and Fear's base case is still remaining on the important views that it will become very clear to the investors as the time progresses, especially for the Fed rate decisions. Now, of course, the analysts and experts are estimating it might take at least 6 to 9 months for the picture to be clear.
Thanks, Sharad, for that. But let's get stock specific and discuss the stocks which will be in news today. Axis Bank definitely will be in the spotlight because finally that deal with Citi is coming to a fruition, and they have announced that they're likely to take over and acquire Citi's India's consumer business and the NBFC business by March 1st itself. Let's go across to Harsh to understand this better.
Well, yes, Axis Bank is in focus because they've announced that firstly, they're going to complete the Citi retail acquisition by the 1st of March. So that's a key positive coming through. Of course, this also signals the fact that they've been able to onboard the requisite number of clients that they wanted to onboard from Citi. Now, Morgan Stanley has an overweight on Axis Bank, target price at 1200 a share. What they are suggesting is that the Citi acquisition being in line is obviously a plus, but they are structurally positive on the turnaround story that Axis Bank currently is and the Axis Bank franchise as well. What they are saying is they expect ROEs to be around 16% by FY 24-25 and at a valuation 1.5 times FY 24 expected price to book. Things appear quite attractive for Axis Bank. They are expecting a target price of 1200, which is a very solid 40+% upside on the stock.
All right, those are the latest updates on the Axis Citi acquisition. Moving right on then, Arvind Subramaniam has resigned as the Managing Director and CEO. This is of Mahindra Lifespace, as he has decided to move on to pursue his personal interests outside of the company. What could be the implications and how has the street really read into this news? Let's take it across to my colleague Vamakshi, who joins in. Vamakshi?
Well, absolutely. Mahindra Lifespace Developers is in focus today after Mr. Arvind Subramaniam has resigned as the MD and CEO with effect from 22nd of May 2023. Now he has decided to move on to pursue his personal interests outside the company, and in his place, Mr. Amit Kumar Sinha will be appointed as the MD and CEO. Now, Mr. Amit Kumar Sinha had joined the Mahindra Group back in November 2020, and he was appointed as the president of the group strategy. Now, prior to that, he was also a partner at Bain, a senior partner at Bain for nearly 18 years, and at Bain he had the opportunity to work with several real estate developers. At Mahindra Group, he has led several high-impact projects that covered growth, transformation, as well as capital allocation across group companies. He also happens to be on the board of several Mahindra companies with the likes of Mahindra Finance, Mahindra Logistics, among others. Now, the company also hosted a con call yesterday in order to introduce the new MD and CEO and share its business outlook for the near term. They also believe that the RE business can be significantly scaled up and in fact has the potential to generate significant value for the shareholders. The management declined to comment on the departure of Arvind Subramaniam, but they assured that the new management has the capability to further scale up the business. The group is also willing to infuse more capital into the business as they believe that it is capable of generating over 15% of return on equity. The company's top priority is to deliver on the guidance, and in fact they are on track to achieve a pre-sales guidance of nearly 2,500 crores by FY25. Now another priority for the company is to make a significant presence in the markets that they operate in already, such as Mumbai, Pune as well as Bengaluru, and for that they will be doubling down in existing markets by further accelerating new land as well as project acquisitions. So that was Mahindra Lifespace Developers for you in focus on the back of the change in management and positive outlook that the company shared in the con call. And now let's quickly listen into what the management had to say in the con call.
We wanted to make sure that we were transparent with all our investors as to where is this business going, what is our view on this business as a Mahindra Group. That was a primary objective of this call, to introduce Amit as well. You're right about the past, and that, all of you are in. It is what it is. There are many things about the past that, or in fact, not many things. There's everything was. What we can tell you is what we feel about where we are today and what we feel about where we are going from here. And with the leadership team at Life Spaces today and with Amit coming in as CEO, I would tell you that personally, and in many ways, I sit with you as the Mahindra Group is an investor in Life Spaces. As an investor, I feel very comfortable about where this company is and where this company is headed with this management team.
Okay, and now to another stock which is going to very well be in focus, and ET now was the first one to tell you, and now it's a newsbreak confirmed that the Ministry of Corporate Affairs has approved the revised demerger plan for Shipping Corp of India's non-core assets. Prakash Priyadarshi, my colleague, was the first one to tell you about this. He joins in again to tell us what exactly is in the works.
Yes, it's a confirmation of our news break as Ministry of Corporate Affairs has given final approval on revised demerger plan of Shipping Corporation of India's core and non-core assets. ACI has confirmed that it has received final approval from the Ministry on revised demerger plan. Remember, company had some apprehension on original demerger plan of its core and non-core assets. Taking into consideration, Ministry had invited comments from all the stakeholders and completed final hearing last month. But today, it has given final approval on a revised demerger plan. Under this plan, a new firm, Shipping Corporation of India Land and Assets, will handle non-core assets of the company. Also, rupees 1,000 crore will be transferred to the new firm under a revised plan. It will also pave the way for the divestment of Shipping Corporation of India going forward. DIPAM will start process. Back in December 2020, DIPAM had invited EOI for the company, but it was stuck due to pending demerger plan of the company's core and non-core assets. However, divestment anyway likely to be completed in the financial year 2024.
All right, thanks very much for those details. That stock was certainly a buzz in yesterday's trading session. To some more top fundamental stock ideas, and let's hear it out from Pankaj Pandey of ICICIdirect.com. What are some of his top ideas within the mid caps and large caps?
From a sectoral perspective, I think we have started liking some of the PSUs, say for example NTPC or something like say ONGC. Besides that, I think our sense is that banking has been sort of struggling for some time, but given the fact that IT overall, since the US Fed is still hawkish, probably the kind of run-up what we have seen in the 5-6 probably 1.5 months in IT probably might take a pause, and banks ideally should sort of do better from that perspective. And you've seen banks sort of doing well, especially on the unsecured side of the portfolio. Most of the banks have been sort of inching up that portfolio. So NIM expansion can still sort of pan out in the next quarter. And valuation look reasonable to us. So we like something like HDFC Bank or Federal Bank. And then I think in some of the mid caps, for example, Techno Electric is one company which missed out in terms of numbers, largely on the execution side. But our sense is that Q4 ideally should be a lot more better than what we have seen. We like some of the other names like Action Construction Equipment, largely from a overall capital goods perspective. And then within software, we like small cap companies like say Newgen Software, where the management is quite confident of delivering good double-digit growth over the next 2-3 years.
Okay, those were some of the small cap bets coming in from Pankaj Pandey. But let's talk about some of the stocks which will be in spotlight today. We talked about Z Entertainment, but remember it's out of FNO today, so that stock will be in focus on account of that as well, because the margin call etc. will increase on that counter. Yesterday we saw a solid recovery. Whether that will continue today or not, we'll have to watch out for. Mahindra Lifespace, wherein we discussed how the current MD and CEO has resigned. Amit Sinha has been named as the MD and CEO designate, but given the fact that Dr. Anish Shah, the group CEO, was attending the call yesterday and trying to clarify that, that tells you that the kind of importance the company is also, or the group is also putting towards Mahindra Lifespace. Axis Bank, wherein the acquisition of Citi's cards and retail business is expected to be completed by March 1st. We also had Morgan Stanley coming out with a fresh note talking about a target at 1,200 rupees as well. Alchem Laboratories also has a positive news that might have a positive rub-off impact as well. They've got the establishment inspection report for the Indore facility after inspection, and that's the positive. KSB Pumps reported their numbers yesterday. The margins expanded to over 14% versus 12% earlier. So that's the good news coming in there, and the revenues also jumped up. Also, Electra Green Tech will be one stock which will be in focus on account of those pilot hydrogen buses that they have established in tie-up with Reliance. But let's discuss some of these counters with Sandeep Sabharwal as well. Sandeep, hi, very good morning. Thank you so much for making time and speaking with us. Just wanted to begin by asking you about Mahindra Lifespace, if you track that company very closely, because when Mr. Arvind was at the helm, the gears of the company had suddenly shifted. They became very aggressive with respect to their expansion, etc. But now with the management change coming in, do you think the pace of aggression will actually slow down?
Sorry, not tracking that company at all.
Okay, so if not Mahindra Lifespace, is there any other name from the entire real estate name that you have been tracking and that you like?
See, real estate demand has held up despite the rate hikes which we have seen, and that's what we hear from most of the real estate companies. The only issue has been that the price increases have stalled, and to that extent, what we've seen lately in the results is that there's been some margin squeeze, and that's got reflected in the stock prices also. I think it's a wait and watch scenario to pick up stocks like DLF, Sobha Developers, or Oberoi Realty. I think Godrej Properties. I think all these are good companies, but I still think that we need to wait out for some more time, because this sector is most sensitive to monetary policy, and we could see some better value over the next few months.
Okay, the other one which is going to be in focus is going to be SCI today. The Corporate Affairs Ministry, like we just told you, has backed the revised demerger plan, and the MCA has approved demerger plan for non-core assets of Shipping Corp of India. Now, we don't know what really constitutes in this entire non-core asset plan or the cluster, but it seems that 1,000 crore rupees are going to be transferred to non-core assets. Sandeep, you think this is going to once again renew the entire PSU, in particular the divestment pack?
The disinvestment on a strategic basis has been very tough. Even for simple companies like Concor, it's not really happened. So I think trying to play the disinvestment game in the stock markets again and again makes no sense. I think it's just speculative activity which ultimately goes to naught.
Meantime, Sandeep, morning, wanted to get in your take as well as to all that's transpired so far with respect to Z Entertainment, the fact that now the company coming out and saying that they filed an appeal in the NCLAT. Some of the brokerages are of the view that perhaps now the worst is already priced in, things could not get worse from here. But doesn't this raise a lot of question marks as well when it comes to the merger with Culver Max?
I think in the overall context of the merger, my view is that this NCLT plea is a small one, and it's unrelated to the entire merger process. Actually, it's trying to put pressure on by the bank to get their dues back. So let's see what happens in NCLT. However, overall, my directional view on Z is that all of us know ad market is going away from general entertainment channels, and subscription revenue is also stalling. But the programming expenses are only going up, and the OTT foray also has been not very great. So overall, directionally, I don't see any story in Z even post merger. However, it will keep on presenting trading opportunities. So when it gets oversold, one can play for trading bet. But if for a long-term 2-3 year view, I wouldn't look at this stock.
Kunal, in fact, I want to pick up on the price action on Z and the kind of pounding that the stock got yesterday. Of course, today, it's out of F&O ban. But yesterday it did see a massive recovery again then after that gap down start. What next on the charts?
Yeah, there was some intraday recovery, but then net the stock was still down some 7.5% on closing yesterday. It still closed, I think, a tad bit below the 200 mark. And, I would agree with Sandeep as well that largely the stock has been just a trading stock. And I remember that the best part of the trend which happened for Z was when the stock rose up from 170 to I think 350 plus in a matter of couple of months in 2021. But other than that, the stock has been unable to live up to the hype and the expectations which had been built at that point of time. There were rallies in between, but those rallies were never converted into a major kind of a trend for Z Entertainment. The resistances on the monthly scale. So when you look at the monthly charts as well, the resistances have been flowing down. So from 350 earlier, the resistance fell to 280 levels, 250, and now the recent resistance for the stock was just on the 220 odd mark. So the fact that the stock has been making lower highs, that itself is an indication that the trends for these stocks are not long-lived, they are very short-lived. And I think it makes a lot of sense to just have short-term trading opportunities over here rather than any kind of a meaningful position from a longer-term play.
Okay, so that's the take coming in on Z Entertainment. But Naresh, wanted your take regarding ITC. That's one is heading around that 400 rupee mark, and NMDC too saw quite a bit of price volume action towards the end of the trading session. We have a fresh brokerage note this morning from Motilal talking about how there could be an over 30% upside on the counter. What's your take?
So ITC is now on the opposite end of the pendulum, wherein at 200, 220 nobody was interested. At 380, 400 everyone is interested in the stock. But the price action is not as strong. So say if you look at the last week, it came to 385. Before that, it came to 385. The spikes are not very sharp. So this indicates there is a possibility the stock may get into a time-wise correction going forward. So at 400 to 420, one should be looking to book profits, not a buy at current levels. One should wait for a dip back if it eventually, whenever it dips to 350 odd levels, that is where the risk reward would be good. So it is better to just avoid at these prices. The return has been made and time to book some profits. So would avoid ITC. NMDC is something which is not really getting into momentum. It is still sideways. In the last couple of weeks, it's tried to form a bottom around 113 to 115 zones. So out here, it's a risk reward buy. One can keep a strict stop loss at 115 and expect a bounce back towards the 130 mark going forward.
Okay, let's also hear it out from Dipan Mehta as to why he's picking up Mahindra Holidays and IHCL.
It's better to buy the hotel companies. I think look at the way Indian Hotels reported, what kind of numbers they have reported, and some of these smaller hotel companies as well. And I would say that that's a better way to play this particular investment theme rather than the aviation sector. The hotel industry, there is anyway a crunch when it comes to capacity. It is not all that easy to increase hotel capacity. It takes at least 3-4 years to build new hotel rooms. So that's the way we'd like to play it. Another company which comes to mind is, of course, Mahindra Holiday, which is a vacation company, and that also has reported decent numbers last few quarters or so. Very attractive valuations and a lot of cash on the books as well. So I think that's the way to play these two companies, rather this particular sector per se.
Okay, I also wanted to talk about Pricol because that stock has been in focus ever since Minda Corp has actually picked up 15.7% stake from the open market. And now Minda, remember, in their con call had said that it's purely a financial investment and they're looking at various other methods of deployment of cash as well. But there was a con call that was held by the Pricol management yesterday wherein they sounded quite confident that they would be able to battle it out and hold their ground when it comes to their own ownership and wouldn't let a hostile takeover really take place. Let's listen in to what the management had to say on the con call because they're also talking about how the institutional investors are backing them at the moment.
The promoter group of Precon, represented by me, stands committed to stay vested in Precon, grow Precon, and create value for all of our stakeholders. My management team, consisting of Ganesh, our CEO and Executive Director, our Director Technology, Amir Dastagir, our Director Strategy, Siddharth Manoharan, and CFO, Priyadarshi Bhatia, stand committed to leading this organization along with our respective teams in the coming years to take it to greater heights and greater glory. PHI holds a 5.73% stake in the company, to be precise, and they have endorsed our present management and have assured of their support, and they will continue to stay vested with the company for the short to medium term.
Sandeep, wanted to pick up on the recent correction which has also played out within the hospitality space, and we were chatting with Kunal that IHCL cracked below the 300 mark as well. Of course, yesterday it recovered as it did day before as well. But at these levels, around 300, 305, would IHCL still be a buy?
In hospitality, especially hotels, there are 4-5 stocks only, and among the larger ones, there are two: Lemon Tree Hotels and Indian Hotels. Both the companies are doing well, and it's too early to keep a call for a peak in their overall operations, growth, etc., given the dynamics of the entire hotel industry and how the recovery is playing out. So I would think that any weakness in both these stocks are good buying opportunities. The story should last for another 2-3 years at least. Obviously, when the stocks ran up too much, now they have corrected. I think that's a good opportunity for new investors.
All right, this morning, some of the brokerage notes then include Morgan Stanley's view on Axis Bank. They've maintained an overweight rating with a 1,200 rupee target price. They're expecting that the proposed acquisition, as Harsh highlighted by Citi, has been progressing in line with expectations. And then there's also NMDC, which is on Motilal Oswal's radar, a buying opportunity, saying that it's very well placed to capitalize on the growth opportunity ahead. Sandeep, just wanted to get in your thoughts on both of these. If you've had a look as to what the valuations are when it comes to the Citi acquisition for Axis and how things are progressing on that front, as well as a view on NMDC.
Given that Axis Bank now has said that 1st March the integration will be done, obviously some technological integration would still be left. And given the overall valuations of Axis Bank and how it's come up, I would be positively inclined on Axis Bank. In terms of valuations also, it's cheaper than all other large private sector banks. Obviously, it deserves to be cheaper than some of them. But if you see vis-a-vis Kotak, it's nearly 50% valuations, whereas growth profile now is almost similar. So I would think that Axis Bank, in terms of a percentage gain potential, should do well going forward.
Well, in a surprise move, or maybe not, the Biden administration yesterday has nominated former MasterCard CEO Ajay Banga to be the next president of the World Bank. In fact, the nomination is going to kickstart a confirmation process before that could take weeks before a final decision by the World Bank's board. Remember, the World Bank president is almost always an American citizen nominated by the United States, and Biden said in a statement yesterday that Ajay Banga is uniquely equipped to lead the World Bank at this critical moment in history. Biden also added that Banga has spent more than 3 decades building and managing successful global companies that create jobs and bring investment to developing economies and guiding organizations through periods of fundamental change. How cool would that be?
Oh, well, yes, and one more Indian being at the helm as the top boss at a lot of these global organizations. Recently, we had Neil Mohan taking over at YouTube. We, of course, have... Yeah, of course, and a whole host of them, right? Right from Sundar Pichai to Satya Nadella, and then we also had Ravi from Infosys moving on to Cognizant. So I think that's just increasing the number of Indians which are actually,
at the helm of these big, large global institutions.
Yes, absolutely.
Yeah. But the Aon survey, Anisha, I think that was the surprising one. While the e-commerce and the entire new age tech stocks are getting battered, but they are the ones paying the maximum salary hikes.
Dollar. Yeah, at least they're still suggesting that there's going to be a double-digit hike coming in the salaries this year. So that's something positive to take home. 10.3% is what they're suggesting. They're saying that it's going to be a bit lower than 2022, but given the way the global economy is panning, I'm sure people with like 10% hike should be happy with it. Of course, they're talking about how different verticals are doing. So IT is still expecting around 11%. X-commerce might see a jump of around 12%. And I'm sure the big bucks will be coming in from the financial services, the investment banking space, because those are the ones which always lead the growth there. But yeah, otherwise it's broadly in that 10 to 11% range. So let's see how it pans out. Not too bad at around 10.5%.
Sandeep, how surprising is that the Aon salary projections came about yesterday, and e-commerce, it seems, is projected to give the maximum salary hikes in this year at 12.25%. Then, of course, is professional services, and then IT platform and products.
I think in some areas they might be right. For example, in manufacturing, in retail, etc., where the demand would be high. So there it's possible. But I think on IT, etc., it's very tough. In fact, we hear of salary cuts now rather than salary hikes.
But I guess that will mean that for the IT companies, there would be a bit of a pressure on margins as well. We were expecting that the supply side pressure might be getting done with. There won't be big hikes coming in because last year it was a very heavy base of hikes coming in. Plus the entire attrition was having an impact. Yeah. Sandeep, your take as far as the IT sector is placed now, because we have seen a solid recovery this year already with 7% gain at the index level and individual stocks gaining anywhere between 10 to 25%. Would you still look would you still be a buyer or would you stay away?
No, I'm largely underweight on IT, mainly due to concerns on demand as well as margins both. So the stocks recovered rapidly along with the recovery in the Nasdaq because there is a very high correlation with the Nasdaq and the expectations of a soft landing in the US. That soft landing might still play out, but given what the guidance of most of the technology companies in the US is, the job cuts which are playing out there, as well as commentary from some other companies which outsource significantly, it looks like next year might be a bit slow on growth. So, and I think there is excessive optimism around IT stocks. So I would be cautious at this stage.
Yeah, well, IT has somewhat seen a good amount of recovery, at least in the last 1 odd month or so. Even in the series, if you were to just stack up how some of the IT stocks have moved, or for that matter, how the new age tech stocks have actually seen a massive recovery from their lows. But yeah, it's not like the headwinds are all clear still. But since we're talking about the new age tech stocks, they may be on the road to recovery as most of them are substantially off their recent lows, like I just mentioned. Sharad is joins in to tell us exactly what's been aiding the stock price movement. And Sharad, more importantly, if the risk-reward ratio is now turning favorable for the new age tech goals.
Well, yes, a lot of fund interest is also coming in, as you rightly pointed out. But let's look at the numbers, how it is panning out from almost 2022 lows itself. Stocks such as Zomato, Paytm and even PB Fintech, they are up more than 30%. Even a stock like Delivery is also up 8%. Barring Nykaa, all of them are in the positive numbers. But then there are important key triggers, of course, coming in. Q3 numbers were largely good, especially for PB Fintech and Paytm as well. And the investors have stated that the entire risk-reward ratio has turned favorable. However, overall, the valuations do still seem a bit stretched. But the thing is that there is a focus on cost optimization now, apart from chasing growth, which was earlier the main cause of concern. Apart from this, important thing is there's an important exit of PEs is happening, VCs are also happening, and because of that the post IPO supply numbers, they are also kind of getting normalized going ahead. But also fund buying is coming in and brokerage upgrades also coming in, especially for PB Fintech and Paytm as well. Now let's look at the path to profitability. That's the most important thing which we check for the new age tech companies over here, and Paytm has actually received it 3 quarters ahead of its guidance. While for Zomato, PB Fintech and delivery, it is still under progress as well. But there's just a caveat that Nykaa is already profitable since listing as well. But there were some good surprises coming in the third quarter as well. Apart from, of course, Paytm's good news, there was Zomato. For the month of January itself, they have turned EBITDA positive. Now this is without the Blinkit acquisition, and for PB Fintech also, their credit business also turned EBITDA positive at least 1 quarter ahead of their guidance. But a lot of adjustment coming in the Q3 numbers, but the only time will tell when we see the actual PAT numbers coming in the green.
Right, that's interesting, but at least the fact that a lot of these companies are actually laying out the roadmap for profitability, I think that's going to be music to the ears of investors who have waited long for these kind of comments. In fact, in our latest series called Class of 21, for the companies that have actually made their debut on D Street in the last 2 years or so, we caught up with PB Fintech CEO Yashish Dahiya, who shared his guidance and affirmed that yes, the company is on track when it comes to their growth targets. Listen in.
The last reported data, and if I take the ESOP charges away, you're actually making money, which means there's no cash burn.
Yeah.
And you've given a guidance that you will be positive, which is profitable, in FY24.
Yes.
Define that for us. First half, second half, first quarter, second quarter.
No, full year. When we finish March 24, because see, we are a seasonal business, so you have some seasonality, etc. When we finish March 24, overall for that thing, we would be PAT positive, is my estimate.
What could challenge your estimate?
Not too much. I'll tell you why. See, in our first year, we had ESOP charges of about 700 crores. Those will be down to 300 automatically. So that is a delta. We have 5,000 crores of cash that generates interest income. We have a renewals business which generates about 300 crores of revenue. It should generate about 450 crores next year. So, and that is a very high margin business. So all of this put together pretty much guarantees it. See, if anybody noticed, last quarter we did make 87 crore loss, but our ESOP charges were 111 crores.
Over 100 crores.
Yeah. So the moment you take that out, we were, from a cash perspective, we have been not burning cash for a while. Our cash balance was the same at IPO as it is today. And that's why I'm saying, I think what I was trying to tell the market is that yes, you're seeing losses, but those losses are ESOP charges, which are an
That's
accounting...
not operating loss.
Which is an accounting charge, because the ESOP charges are for 5 years. You're giving the same amount of ESOP every year, but in the first year you're charging 700 crores, in the last year you're charging 40 crores. For the same amount of ESOP every year. So that is just a delta of 660 crores that comes just from the ESOP charges.
So when you say a number of 1,000 crore for FY27, how are you deriving at that number?
See, if anybody does the mathematics, our renewal revenue keeps growing. Our new initiative losses are coming down, and it is expected by 27 they would break even. So they'll be at zero. Our core business, is already positive. It's already made 100 crores of positive EBITDA this year. And the ESOP part is going to disappear, because that is a notional charge which you're seeing right now, but that will not be there after 5 years. You put all of that together, and there is no way you will come out with a different number. It's not my number or your number. It is about just understanding how the renewal, and please appreciate, I'm not even building business growth into it.
What is the business growth according to you?
Broadly about 30% on fresh business, roughly about double the rate of the industry is what I would say.
Okay, it's 9 a.m. Let's take a look at the pre-open rates as well. Of course, they'll take time to settle because it will be great news if we do open at 17,700, though SGX Nifty is much off that level, so they definitely need time to settle because the Sensex is not that excited. It's up just around 0.1%, but it's Nifty which is showing a solid gain of 1% at least at the moment. We'll allow those rates to settle, but let's discuss some of the counters in greater detail. Kunal, I wanted your take regarding some of these real estate names. DLF, for instance, is saying that they're looking at prepaying some amount of NCDs as well, so that's a bit of a positive news. But the stock hasn't been doing much, though if you look at the recent launches, the data on the ground suggests that the launches are doing well.
Yeah, but I think none of the real estate stocks have done exceptionally well. So, I think in fact, the one which has suffered the most is Godrej Properties, the stock which I think topped out at 2,500 plus levels in 2021, early 2021. And from there, the stock has corrected very, very sharply. I mean, a correction of more than 50%, 60% in a time span of 1.5 year is a steep correction. And even with the recent charts, it indicates that the correction or the selling is not yet over for the stock. And I think in that aspect, stocks like DLF, Oberoi Realty, I think these stocks have done reasonably well for themselves. DLF, I think, has been holding on to this major support of 320, 300 broadly over the last 1.5 odd year. So I think it's a sign that possibly the move from the real estate pack is moving on to those slight high beta names, the likes of DLF, etc., and the likes of Godrej Properties, which were erstwhile considered to be more stronger ones. They are the ones which are going into a corrective mode. DLF particularly, I would probably expect that once the volatility settles in, the stock could probably make a comeback towards 380 to 400.
Right, okay, time to get in some mid-cap ideas as well. Going on that note, Kunal, on your list?
So India Mart is a stock which I would be bullish on. The stock is very close towards breaking out of a multi-month, multi-swing high at this 4,800 mark. I think it's just 10-20 rupees away from this 4,800 level. So on confirmation would suggest a buy. Targets of 5,000, stop loss at 4,700.
Right, Naresh, what about your mid-cap strategies?
So that would be a buy on Wonderla with a stop loss at 420 and a target price of 500. And the stock is shaping up for a long-term breakout. After listing in 2014, the stock made a top around 430 levels, which was seen again in 2018 and then in 2022. And recently, in the last few sessions, it has come back to that 430, 450 mark, on verge of a flag breakout on a very short-term time frame, and on verge of almost a 8-year breakout. So it looks like a new trend starting up. Good volumes after the recent quarterly results. The stock gapped up and has continued to hold on in the current market conditions as well. So expecting it to make another big move.
All right, those are your top mid-cap strategies, Wonderla and India Mart. That's what's been picked out by our chartists. All right, let's move on then to other top headlines that we're tracking. And the U.S. Treasury Secretary Janet Yellen has made a strong pitch for increasing financial support to Ukraine to help it battle the year-old Russian invasion. While speaking in Bengaluru at a G20 meet, she also said the U.S. is looking to strengthen sanctions in Russia. Meantime, the FTX co-founder Sam Bankman-Fried was hit with 4 criminal charges, including ones related to commodities fraud and making unlawful political contributions, in a superseding indictment filed in the New York Federal Court. The new charge document lays out a greater detail of his fraudulent conduct related to the cryptocurrency exchange. Moving right on then, Netflix has gone ahead and cut the prices of its subscription plans in some countries in the Middle East, Africa, Latin America, as well as Asia. The streaming giant looks to maintain their subscriber growth amid the stiff competition and strained consumer spending. The stock price fell nearly 5%, underperforming the broader market, on course for its worst day in over 2 months.
Okay, so that's some good news coming in for the OTT lovers, but not here in India. But a day before the end of the campaigning for the February 27th Assembly elections in Meghalaya and Nagaland, Prime Minister Narendra Modi will campaign in the 2 northeastern states today. PM Modi will participate in a roadshow and address an election rally in Shillong. Hours after a dramatic arrest by Assam police in Delhi, Congress spokesperson Pawan Khera was released from Delhi's Dwarka court. He walked out on a bail bond of 30,000 rupees. The Congress leader was arrested over his distasteful remark on Prime Minister Modi during a press conference earlier. Well, defending champions Australia held their nerves as they beat India by 5 runs in a thrilling Women's T20 World Cup semi-final. All hopes dashed for the women in blue to pick up the trophy because they're out of the tournament now.
Okay, and after a volatile February series, largely led by the roller coaster ride in the Adani Group stocks, let's find out what's in store for the month of March. Sharad is back with us to tell us exactly that. Sharad?
Well, yes, first the discussion will be on the FIs, and going into the new series itself, there's a cautious stance coming in from the FIs as well. Now, overall, they have entered the new series with a higher net shorts coming in the overall FNO segment itself, and even this also pertains for the index futures as well. This is where their net long positions are actually kind of significantly reducing, especially for the index calls as well. Now, for the index futures also, the net short position that has increased on the higher levels as well, and overall, if you see the FIs, they have entered the new series with a higher net longs also when it comes to the index puts. Now, first we have spoke about the FIs, now we talk about the HNIs, and over here itself the speculation, those numbers are actually coming down, and of course the volumes have also become less in the market, and they have stated that the HNI clients have actually entered the new series for the month of March with a lower net longs coming in for the index futures as well.
So in your definition in this market where things are reasonably priced, what is cheap and attractive?
Two new sectors that we've been trying to bet on is particularly some of the defense and railway PSUs. And given the government's capex push in railways particularly, I think there's some very cheap stocks, I'll use that word advisedly, cheap stocks in the railway space. And if you notice the last few days, there's been a lot of noise of India becoming an export powerhouse in the defense sector.
All right, let's find out what the index calls are from our chartists this morning. We've started a brand new series, and for now, it's holding out by 0.5% on the pre-open rates. Hold according to Santosh as well as Kunal, and a buy on dip strategy. That seems to be the tone from our experts this morning, and that's the consensus call on the Nifty. It's advisable to hold, say our chartists. Moving on to the Nifty Bank, and that's exactly the strategy that they continue to have. Pretty much a whole recommendation is what the consensus call is. Naresh believes that it's a buy on dips when it comes to the Nifty Bank, and that's exactly what the Moodometer indicates.
Okay, let's discuss some of the other counters which are buzzing around. Kunal, Naresh was quite positive about HDFC Bank as well as SBI. Do you think these are the two, best candidates from the banking space? And is banking one of the top sectors that you would like to bet on at this point of time?
Well, I would not like to go extremely contra over here because it's very difficult to try and pick out which shade of the bank Nifty would start to perform. Now, yes, there's a lot of expectations that HDFC Bank, SBI, and such other stocks which have been languishing as such, they could probably make a comeback. But till the time there is no evidence on the charts that these stocks have started to get into a relative strength. Forget about any kind of a major recovery. But even if these stocks stop falling or not fall as compared to the overall market or the indices, that itself would be a sign of relative strength for these stocks which comes by. So I would probably wait out for those evidences. As of now, they are not being spotted on the charts, whether it's the private sector banking names, large cap ones, the mid cap ones, or whether it's even the PSU banking stocks, both the large caps and the mid caps.
Naresh, I also wanted your sense regarding Voltas, because at least as far as the fundamental view is concerned, there's very, different view, divergent views coming in. Jefferies was quite positive, saying the summer is going to be great. Goldman Sachs this morning is saying that everything is priced in. And despite the underperformance of 2022, don't expect the stock to have a runaway rally in 2023. What's your take on Voltas and the entire consumer durable space, Naresh?
So Voltas made a sharp correction over the last 1 year. It topped out around 1350 and went all the way down to 750. and in the last, say, a month's time or a little lesser than that, it has moved up from 750 to 920, 930 levels. Now, 920, 930 was the peak in October, November, as well as the support which was in May to September. So 930 is a stiff resistance going forward. So I would expect it to consolidate here for some time. Dips back to 850 to 860 would be a zone where it could become a buy. And again, go back towards 930 to 1000 levels. Overall, seems a bottom is in place. But at these prices, the risk reward is not there. So a little dip here would be interesting as a buying trade.
Kunal, what about the cement space, given that we've been seeing a bit of traction building up here? Your favorites?
So it still be large cap names like Shree Cement and Ultratech Cement. I think these stocks have done reasonably well. They've managed to surpass their resistances first when the entire cement rally started off, and they've been the most stable ones. The beta over there, the volatility over there has been significantly lesser. I would say maybe even 50% less as compared to the high beta pockets or the high beta names within the cement pack. And I think more importantly, for example, Ultratech Cement has managed to cross above those psychological round figure marks of 7,000. Shree Cement comfortably above the 22,000 plus mark for itself. So all of these are very strong psychological breakouts for these stocks. So I would probably prefer the larger cap names, and the corrections which the markets have shown the last 2-3 days, those are classical opportunities where one could look to buy them on dips, and especially if these stocks come back to their very short term key moving averages.
Right. Okay, a couple of block deals as well, which are currently happening. And Redington, almost 188.6 million shares have actually changed hands in a bunch trade. Redington is the stock that I'm talking about. There's been a sizable block deal there. In the pre-open rate itself, you are seeing quite a bit of move there. And it seems like Cinex Mauritius could be the seller. In the meantime, let's just also take stock of how some of these newsmakers are actually panning out. And I definitely want to check in on Axis Bank. They are hoping now to complete Citi's consumer business acquisition by March 1st. I want to see what Z is up to, considering the stock is now out of the F&O ban. Let's see what kind of price action Z is seeing. Getting slammed there, 5.5% lower after the NCLAT is now going to hear the plea against the insolvency, which is going to happen today. And the, of course, exclusion also from F&O happens from the month of May. DLF, they're looking to repay NCDs worth about 500 crore rupees, which are going to be, maturing in the month of March. RVNL, another order win, 197 crore rupees. And then, of course, there's Electra as well, which is going to develop a hydrogen bus in technical partnership with Reliance. That's going to be the other stock to look out for. It's a big gap up move on Electra Green Tech, stock holding up 7% as we speak right now. Kunal, you just talked about ITC, but ex-ITC, do you see as much of a build-up in the FMCG pack?
Not really. In fact, most of the other stocks like HUL is trading at with a negative bias. I think the stock is down some 15 to 20% in the last 1.5 odd month. The likes of Marico, Dabur, I think these stocks have also underperformed. The only stock which I think has outperformed is somewhat relatively outperformed is Britannia. The stock has been relatively more strong. It's not succumbed to any major correction. I think the best which I've seen at least over the last 3-4 months of price patterns is that after a swift rally for Britannia, the stock has gone into a time-wise consolidation or time-wise correction where the stock has remained to a range of 3% to 5% broadly in that kind of a time span. So I think that's the only chart over here, and that is why it becomes very difficult to anticipate that which are the sectors which could probably lead the turnaround, because most of the stocks within sectors, even if it's a defensive pack like FMCG, these stocks are struggling.
Okay, so those are the stocks that you need to have on your radar. But let's quickly take a look at some of the other buzzers as well, at least in the pre-open, because there's just 20 seconds left for the markets to start, because the handover was quite positive from the US markets, Aisha, and that's the reason perhaps we're expecting the start is going to be on the positive side. Not a huge thumbs up, but at least we'll take any amount of green on the screen.
Yeah, just about any amount. It's been a high volatility the entire series gone by, and we've even reached that 17,500 print. So definitely could do with some amount of relief, when it comes to the March series. But let's see how we kickstart, starting off on a fresh slate with the Nifty higher, just marginally. 17,576 is where we're currently at. Let's see whether the banks are seeing any meaningful recovery or not, because that's the other part of the market which has been languishing. For now, at least on the opening tick, you've got a half a 4% uptick coming in for the Nifty Bank. Axis Bank, after them hoping to complete Citi's consumer business acquisition by March 1st, I can see a green print on Axis Bank. It's good to see that there is quite a bit of relief actually on the Adani group of names, considering these were the ones which really dragged the market lower, or at least the sentiment lower, and dragged a fair bit themselves. Adani Ports, Adani Power, Adani Enterprises, all of these stocks are holding up in the green as we speak right now. What is Z then up to? And I'm sure there's a big crack there. The stock is going to be excluded from F&O come May, and it's out of the F&O band today. Z is down 3% as we speak right now. 192 is where the stock is struggling. Remember, the NCLAT is going to be hearing the plea against insolvency today, so this is going to be an important one. Electra jumped up in the pre-open rate itself, and I'm sure it's holding on to the greens even now after them looking to develop the hydrogen bus in technical partnership with Reliance. There's also RVNL after that order win. There's DLF looking to repay NCDs worth 500 crore rupees. There's Alchem Labs as well, which is in focus. The US FDA has concluded the inspection at the Indore unit, and they've issued an EIR there. So these are a couple of stocks which are going to be in focus. And besides that, also what an ITC is up to, considering this was the more resilient of the names like we were just discussing with Kunal as well. ITC a little bit tempered at 386 thereabouts. Now to the pressure points in the market, which of course outside of the Adani group of names, even were Asian Paints, for instance, yesterday saw a crack of 4% coming in. In fact, Asian Paints has seen a long bout of underperformance now, up about 0.6% as we speak right now. L&T was quite a big loser yesterday. It was down 2.5%. Let's see what L&T is up to as well. And then, of course, what ITC is doing and whether it's not scaling new heights or not. 386 is where that stock is mildly under pressure. The breadth of the market, though, has started off positive, and I think that's a bigger relief right now. Kunal, do you think we'll manage to stay on with the gains or even build on to that for that matter?
I think the first half could be a bit tricky because there would be a lot of unwinding of positions, mark-to-market pressure. So I think on the back of all of that, the first couple of hours for trading would be that to square off positions, mitigate risk as much as possible. So wouldn't be surprised that there would be some tripping off of the gains for stocks as well as for the indices. But in the second half is going to be key because there is a credible bounce in the global markets, and that could probably give an indication for traders to try and carry forward long positions. And if that happens, then probably the second half could be a lot more better than the first half of the day. The stock which I would look to trade at current levels would be Bajaj Finance. That's a stock which I would look to buy. I think 6,200 has been a good strong support for the stock and also forming a bullish hammer pattern on the daily charts.
Okay, I just want to quickly flag off Electra Green Tech as well. That stock has started with a jump of around 11%. Remember, it's the hydrogen bus that they have managed to develop in partnership with Reliance. So let's pull up the intraday chart of Electra Green Tech because that's opened with a solid gain of around 11%. You also have Sanofi, which is reacting to its earnings. Well, it was a bit disappointing at the top line level, but the profitability has shown a good jump of around 46%. So that stock is also up around 4%. Reddington, of course, is reacting to that large trade which happened. 24% equity has actually changed hands, and we are checking the shareholding pattern of the company. It's only one, holder of Syntex, Mauritius, which actually holds that much stake. So the expectation is that that is the one which has likely made that sell as well. On the losing side, of course, Mahindra Lifespace is down 6%, so that stock definitely deserves mention. And interestingly, CSC is losing out on heavy volumes at the moment. It's already 3.5 lakh shares which have been traded, and the stock is down about 6%, so we'll track that. But Naresh, what are the first trades that you are spotting as far as the index and stock-specific recommendations concerned?
So on the index, would wait for a dip. If in the dip we get it closer to 70,500 to 540 band, that's a buy zone. On the stock side, it is HDFC Bank, which is a trade which I expect, which would be a little medium term in perspective, but an accumulation at 1600 to 1570 zones.